There are many unique elements to an oil and gas workout. One of the ones that pops up a lot is the impact of vendor liens and the fact that vendors in the oil patch have lien rights. That's typically 70-80% of the vendor debt of an oil and gas company. It's often overlooked that vendors have secured rights and are at the front of the line and not behind the secured creditors. And that's unusual because in a lot of workouts outside of the oil and gas space, vendors simply have pre-petition unsecured claims. And so what we've seen so far is that E&P companies file motions and pay those vendors up front. And there's a give and take between the vendors' rights to be paid and the secured creditors who are saying, I've got lien rights, I thought I was ahead of the vendors. Another unique element is treatment of P&A and decommissioning liability. Quite often, those amounts are understated in the information provided early on in workouts. And as the workout matures and progresses, it always ends up being a number that's a lot higher than what people think. And also to add to that, except for some very unique situations, P&A and decommissioning liability cannot be discharged or avoided in bankruptcy. Lastly, royalty instruments and derivatives of that are a unique element of oil and gas cases because creativity is the limit on how oil and gas management teams slice and dice their working interest. And as a result, there's always a little bit of ambiguity, at least in the mind of other investors, as to how these instruments will be treated in an oil and gas bankruptcy. And there is some fuel to their argument that they can be treated as an executory contract that can be rejected because of some recent cases out there that have cast a cloud over this issue, going back to ATP Oil and Gas, and then more recently, a decision out of the Walter Energy case, which was based on Alabama law, which is not as developed with regard to oil and gas protection to royalty investors. But in that case, the royalty instrument there was treated as an executory contract and was rejected by the debtor. It's always unclear to stakeholders as to how those will be treated at the end of the day in the plan or in a sale of assets. Unfortunately for E&P upstream companies that are distressed, the options in the toolbox are much more limited than they were a year ago. A year ago, companies were able to tap the financial markets. They were able to fill second lien baskets. They were able to get brand new financings. There was also a lot of momentum for drillcos and other type of asset level investments. That has dried up. So the utter lack of capital right now for a distressed E&P company has forced them to look internally to their existing balance sheet. And so what we believe is that we are at the early stages of a massive equitization of bond and second lien debt, potentially even bank debt. So management teams, now that they don't have the ability to find outside capital, are turning to their existing creditors, rallying around a valuation, and then convincing these creditors to convert their debt to equity. Some of the other benefits are it allows the management team to reset management incentive programs, and it allows creditors to convert their debt to equity, preserve optionality to recover if prices go back up. It also allows management to stay in place and to reset their incentive programs. In order to be best positioned to advise a distressed E&P company or its creditors, a law firm has to have a sophisticated restructuring practice, which Jones Day clearly has one of the premier restructuring practices in the world. We've been involved in some of the most high-profile Chapter 11 cases and out-of-court workouts over the last 10 years.